Welcome to Hidden Business Risk. I'm Dan Butler. Today, we're untangling something I call recognition drift, those small, reasonable booking choices that slowly morph into audit findings or a valuation surprise right when you need it to be firing on all cylinders. With me, Jessica Mays, business attorney, and Eddie Klein, who runs an IT managed services firm and lives in the land of evidence and logs. Jessica, Eddie, good to have you.
Thanks, Dan. Great to be here. This topic sits at a sweet spot for founders, easy to ignore and easy to escalate into a real problem later.
Happy to be here. I get the tech side, how a timestamp or a checkbox can become evidence, or a mess.
Okay, let's start with the hook. Picture a SaaS company that ran a 30-day pilot for several enterprise prospects. The pilots had an automated trial ends, service converts flow, so sales didn't lose momentum. 1 month later, an auditor finds that several pilot customers were effectively still in acceptance testing when invoices were issued. That led to an auditor-led restatement, and it froze an investor diligence process for weeks. The deal hung in the balance, and the company had to reclassify revenue and answer a bunch of awkward questions.
To follow that up with the tight facts, the pilots were billed because the contract language allowed automatic conversion. In practice, delivery and acceptance weren't completed for a subset of customers. Third-party integrations hadn't been verified, and formal acceptance certificates were missing. Invoices went out, revenue was recorded. Auditors saw the gap between delivery signals and invoicing and recommended a restatement.
And importantly, there wasn't a reliable, immutable trail showing when acceptance happened. There were notes in a CRM, a few emails, and an engineer's log entry, but nothing audit grade like a time-stamped export or an acceptance flag you could trust programmatically.
Right. Plain English time. What are we actually worried about when we say earned versus recognized? Earned is whether you delivered what you promised. Recognized is when you put it on the income statement. If invoicing and recognition happen before acceptance, you can be overstating revenue. Bundle that with discounts, deferred fees, and ambiguous deliverables, and you've got a slow-growing liability on your books and a distortion in KPIs like ARR and churn.
Exactly. Failure modes I see over and over. Contractual ambiguity on deliverables, conversion language that assumes acceptance unless the customer objects, vague acceptance criteria, and fees labeled as setup or implementation without defining whether they're for a distinct deliverable or part of a subscription. Those labels matter to auditors and to tax authorities.
Operational red flags, automatic conversions without a verification step, no immutable acceptance snapshot, and UI flows that record accepted based on a single click that sales can fake in a rush. Tech fixes are simple in concept, but often not prioritized because sales hate friction. That gap is where the drift starts.
So let's put on the revenue lens. When I look at recognition choices, I ask, how does this change cash, KPIs, and future renewals? Recognizing too early inflates short-term numbers, masks poor onboarding, and gives false signals to sales and product. It hides deferred liabilities that suddenly pop up during diligence and slow or kill deals. For triage, I'd prioritize contracts that are large, have automatic conversion language, or include material implementation fees. Those are ticking time bombs.
From a legal perspective, small wording changes can shift risk dramatically. For example, instead of pilot will convert automatically at day 31, consider language like pilot will convert subject to completion of agreed acceptance criteria, and list those criteria. If you must have an automatic trigger for revenue reasons, add a short period for documented acceptance, or a clause that treats certain fees as refundable until acceptance is confirmed.
Operational control examples I recommend: add a conservative acceptance pending tag in your CRM and ledger when a pilot starts. Record a time-stamped export of the customer's environment and configuration at sign-off. And keep immutable snapshots, CSV or PDF exports with signatures or a logged API event for acceptance. Those exports are cheap evidence for auditors.
Let's get practical. I want a priority heuristic listeners can run today. Score contracts by 3 dimensions: size of revenue impact, likelihood of ambiguous delivery, and imminence of invoicing. Multiply those scores. Top-scoring contracts get immediate attention. That's a sales-friendly way to triage without paralyzing the whole business.
And for those high-score contracts, here are contract flags to look for: absence of defined acceptance criteria, automatic billing clauses without verification, bundled fees that don't map to deliverables, and ambiguous refund or termination language. If you see any of those, flag for remediation.
From an ops perspective, remediation can be low friction. Add a custom field in your CRM called acceptance evidence and make it required before revenue recognition. Or add an automated workflow that creates an immutable export and stores it in a secure folder when acceptance is recorded. No heavy engineering required. It's discipline plus lightweight automation.
Jessica, can you give listeners a couple of safe amendment snippets, plain language, that preserve optionality and protect revenue without reading like a legal bombshell? Quick, conversational, and usable in an email to a customer.
Sure. Try, to ensure both sides are satisfied, we'll consider the pilot complete when the customer confirms the agreed acceptance criteria in writing or via the acceptance button in the onboarding portal. Until that confirmation, fees labeled as setup are refundable and will not be recognized as revenue. Another is, automatic conversion to a billable subscription will occur only after documented acceptance or the completion of the mutually agreed deliverables, whichever comes first. Short, plain, and it buys you evidence.
I'd add one operational line you can paste into a customer message. Please click the acceptance button once you confirm integrations and testing are complete. That click creates a time-stamped acceptance record we store for your records. That makes the evidence process customer-facing and normalizes it.
Nice. Those are usable. Eddie, let's drill into the specific controls you mentioned earlier. Walk us through minimal ledger tagging, time-stamped acceptance capture, immutable exports, and safe rollback scripts that a non-engineer can run.
Start simple. Ledger tagging. Add a tag like Rev Pending Acceptance to any invoice generated by a pilot conversion. The tag lives in your billing system and filters reports so finance can exclude or flag those amounts. Time-stamped acceptance capture. The quickest is a form that writes to a database and returns a downloadable PDF with a timestamp and user info. Immutable export. Schedule daily exports of the billing and acceptance table into a secure cloud bucket with write-only permissions, CSV or PDF, store with a hash. Safe rollback. Keep a documented reversible process where finance can flip a recognition flag to move amounts back into deferred revenue without changing historical book entries until an advisor signs off. The key is reproducible steps and division of responsibilities.
Eddie's point about division of responsibility is vital. You need clear owners. Sales owns customer communications, ops owns acceptance evidence, and finance owns ledger tags and the final recognition decision, subject to external advisor sign-off if material. That reduces finger-pointing during audits.
All right, time to put this into a 30-day containment sprint listeners can run without redoing the books. Week 1 is inventory and evidence only. Week 2 is a reversible pilot. Add conservative acceptance tags and pause automatic conversions for one cohort. Week 3 is ledger tagging and contract tweaks after advisor review. Week 4 is documentation and auditor-friendly export prep. Jessica, add what you'd caution during each week.
Week 1, inventory. Don't change accounting entries yet. Collect contract copies, identify automatic conversion clauses, and capture whatever acceptance evidence exists. Week 2, pilot a conservative pause for a single cohort. Document owner and rollback steps and notify sales. Week 3, after you consult your accountant, implement ledger tags and apply contract language updates for new pilots. Week 4, prepare a clean, auditor-friendly export and a short memo explaining the containment steps and why you acted conservatively. Repeat, this is not accounting advice. Engage your accountant or auditor before any material reclassification.
Operational notes for the sprint. Week 1, create a shared spreadsheet capturing customer, contract clause, pilot start date, and evidence available. Export any acceptance logs today. Week 2, pick one low-risk cohort to pause auto-conversion and measure sales impact for 14 days. Week 3, start tagging invoices and test that finance can flip and unflip the recognition flag. Week 4, produce a zipped export of acceptance PDFs and ledger tags for each reviewed contract. Keep everything immutable until your advisor says otherwise.
Good. Now, panel triage. If you had to pick the top 3 customer cohorts or contract types to inventory this week, what would they be? Quick answers. Go.
First, large enterprise pilots with integration work. Second, deals that include significant implementation or setup fees. Third, bundled offers, where software, services, and hardware are sold together and deliverable boundaries are fuzzy.
I'll echo that and add any automatic conversion that bypasses an engineer or integration checklist. Also, customers who requested custom onboarding. Those are often the ones with acceptance ambiguity.
And I'd add subscription trials that auto-convert for cohorts where sales promise bespoke configuration and onboarding. Those 3 or 4 categories are where the math of impact and ambiguity most often align. Assign owners, sales for communication, ops for evidence, finance for tagging. Here's a script listeners can use to assign owners. We're running a 30-day revenue recognition safety sprint. Please own X. Collect contracts by Friday, save acceptance evidence to the shared folder, and tag invoices as rev pending acceptance until Tuesday. Short, direct, and assigns accountability.
Quick wins before we close. 5 immediate actions. 1. Inventory any pilot or trial that auto-converts. 2. Capture acceptance evidence as an immutable export. 3. Add a rev pending acceptance tag in your billing system. 4. Send a short contract amendment for future pilots that clarifies acceptance. 5. Set an owner and a timeline for the 30-day sprint. And as a reminder, this episode does not replace accountant or auditor review for material changes.
I'll add a tech quick win. Schedule an automated daily export of acceptance records and invoices to a secure write-only bucket. It takes 20 minutes to set up and gives you audit-grade evidence quickly.
Final wrap. Recognition drift is rarely dramatic in day-to-day ops, but it compounds. Small choices, conversion knobs in product, contract language that says automatic without guardrails, or missing acceptance evidence, create a liability that shows up at the worst possible time. Take the 30-day sprint seriously, but do it as a phased, reversible program and pull in your accountant before you touch the books.
And one last legal note. When you make contract tweaks, keep changes prospect-friendly. The goal is clarity, not friction. Plain English acceptance criteria and a brief refundable period are usually acceptable to customers and much better for your long-term credibility.
From ops, treat evidence capture as customer service. If you make acceptance a clean, painless button or a short checklist, customers see it as professionalism, not bureaucracy.
Thanks, Jessica and Eddie. Listeners, if you want the Revenue Recognition Safety Kit and the 30-day sprint checklist we discussed, go to hiddenbusinessrisk.com to download it. It includes the inventory template, the acceptance wording, the ledger tagging rules, and the export checklist. Remember, not accounting advice. Engage your accountant before you make material changes. That's our show for today. I'm Dan Butler. Take the sprint, not a freeze, and keep building with your eyes open.